Welcome to Accounting High.
I think at the end of the day, we all need to understand our business model and how pricing results in profitability and how that all ties into your profit and loss statement. So I see a lot of people, what they do when they start a business is they may have worked at a firm that was just the price that they charged at that firm, or they go ask their peers what they charge. But the problem with that is everybody's cost is different. So pricing doesn't matter, because if you have your colleague charging $500 an hour, but their costs are $100 and you charge $500 an hour and your costs are $400 an hour, then you're not going to have enough margin basically to run the operations of your business.
You just explained somebody that has $400 cost versus 100. They're probably selling entirely different products too, if their costs are that much different too. So your pricing should reflect what you're selling.
Check out the Cashflow show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow show. The Cashflow show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
What's up, Nikole?
Hey, Scotty, happy Monday.
Happy Monday. Welcome back, students. You're tuning in to episode 19 of the Cashflow show. Today is part 2 of our pricing discussion. We're going to talk about creating a walkaway price and understanding the basics of pricing. So a little bit beyond our strategic look at it last week. This week, Nicole's going to dive deeper and get tactical with us and teach us how to create this walkaway price. Nikole, what's a walkaway price?
Walkaway price is when you're on a sales call and your prospect does not want to pay the price that you presented. So they're trying to negotiate with you. And there's a certain price where if you take on the client for that price, you'll basically be losing money. You won't be profitable. So it's not worth your time to take on that client. Obviously, we want to get the highest price that we can when we're working with a new client, but we also need to know what is our bottom price where it doesn't make sense for us to take this client on. So if they're pressuring you to come down, you know that you can't go that low.
If it's somebody you really want to work with, I mean, you should know beforehand what the lowest price is that you could possibly charge for something. And anything below that, you'd be losing money, basically.
Yeah. And I think at the end of the day, we all need to understand our business model and how pricing results in profitability and how that all ties into your profit and loss statement. So I see a lot of people, what they do when they start a business is they may have worked at a firm that was just the price that they charged at that firm, or they go ask their peers what they charge. But the problem with that is everybody's cost is different. So pricing doesn't matter, because if you have your colleague charging $500 an hour, but their costs are $100 and you charge $500 an hour and your costs are $400 an hour, then you're not going to have enough margin basically to run the operations of your business.
You just explained somebody that has $400 cost versus 100. They're probably selling entirely different products too, if their costs are that much different too. So your pricing should reflect what you're selling.
Right. You could have a colleague that's selling something for $25 an hour, but their cost is only $10, and you're selling something for $500 an hour, but your cost is $495. So which one's better, right? So part of it is understanding what your cost is. And then part of it is also understanding what type of business do you want to be? Do you want to be low cost, low value, or do you want to be a premium brand and have high pricing? And those are two very different business models. So I think the very first thing that we need to do is figure out what type of business do you want to be?
Mm-hmm. And you can command a higher price if you are that more luxurious brand. So we all know out in the world some cheaper, low-cost brands like Walmart, and then some higher luxurious brands like places like Porsche or Louis Vuitton, things like that. Tell me about those, like the difference between these. Is it just perception?
Well, I think Walmart, they're always slashing prices, right? They want to be the lowest price. Their employees are going to be very low paid employees, right? Then you get a company like you said, Porsche, where you might go into a dealership. You're going to have somebody that walks up to you when you get there.
The white glove treatment.
Yeah, exactly. And they may sell a few cars a day, right? But that's all they need to sell versus a Walmart that needs to push through tons of products every day.
So Walmart, all of their costs are going to be a lot lower. Porsche is going to spare no expense on their costs. And they're going to treat the customer like royalty because everything they're doing has a really high margin. And so they can take their time with it and they're dealing with fewer customers at a time. Whereas Walmart, it's just race to the bottom and high volume. People are trucking in and out of there all day.
Yeah. Personally, I would rather be Porsche because I prefer more of a lifestyle business. But I think we've all seen, in our space, right, bookkeeping firms that are charging really, really low prices and they have thousands and thousands of clients and they have tons of unhappy reviews on their website. But also a lot of their customers know that when they sign up for that inexpensive service, that their expectation should be low.
And I think the types of businesses that we run, we want to make sure that we're wowing our customers. We're giving them the best customer experience. And what that means, you have to be able to spend more time with each customer. So you probably have fewer customers.
So a big part of understanding our pricing. So how
does all this play into pricing?
Yeah, last episode, we talked about different pricing models. We talked about hourly billing is as old as time. And ultimately, at the end of the day, for a service business, we are selling time, basically labor arbitrage, right? We're buying somebody's time for X rate, and then we're marking it up and we're selling it for a higher rate. And then the margin is what we make as the business. So the very first step for a service business, it gets a little bit more challenging if we want to move to more of that fixed fee billing model, right? Hourly is just cost plus markup and it's consistent. If we move to more of a fixed fee model, then we need to figure out, when we look across our portfolio of our clients and our team, what does our average billable rate need to be in order for us to be profitable if we're selling something for a fixed price? And the upside of that for us is that we have more potential margin we can make if we become more efficient.
So you have to determine how much work a person can handle, like what is their capacity and what is that person costing you so you can figure out that price.
Right. And so if we're hiring an employee, we're paying them for the whole year.
The whole year.
We're paying for the whole year,
yeah.
Right? Which in a year, and nobody's ever done the math before, but in the accounting space, we know that a full year is 2,080 hours, which is 52 weeks times 40 hours a week.
If you're paying somebody full time, we're assuming that it's 40 hours a week full time, right?
Yes, that would be full. That's what we're defining as one full-time employee's capacity. And I think we need to use the same number in order to compare apples to apples. So if we go back to episode 1, 50, 30, 20 rule, right? And we're looking at our profit and loss statement. We want no more than 50% of our revenue to go into our direct costs. And those would be the people who are generating revenue for us. They're delivering the client services. A big mistake I see people make when they're trying to come up and figure out the margin by project or by client is they include their overhead costs. We don't want to do that. That muddies the water because our overhead costs are typically fixed. And a lot of the stuff that's happening in our overhead costs are unrelated to the profitability of a particular project, right? If we spend more on marketing or we bring in a consultant, that has nothing to do with our profitability of a piece of work. So that's the first thing, is when we're thinking about pricing, we really just want to focus on the actual hours that go into servicing an individual client. So does that mean then that we just simply, we can just double, mark up our labor, double it basically, right? Because that would be, then our cost would be 50% of our revenue. Can we do that? No. In general, we have what I call waste, which could be unutilized time, right? So we are buying 2,080 hours of time from our employees, but there's going to be a percentage of that time where they're on vacation, they're sick, they have admin time. Bigger firms may have a layer of project management where you can't specifically allocate that toward an individual client. There are times when you're onboarding and training new employees. There are times where you have to do rework. So usually there's 10 to 20% waste in there that we can't bill for. So in order to get to that 50% margin, we actually need to make like a 60 to 70% margin at the individual client level or project level. And then we lose that 10 to 20%. And then we go to our P&L, our margin should be good, and our cost should be no more than 50% if we follow that formula.
I love it. So it's a little bit of science to it, to making money and to being profitable.
What that ends up equaling is that we need to multiply whatever our hourly rate is for an employee. We need to multiply that by 3 to 4 times to arrive at their average billable rate target.
Okay. And that's the ABR, average billable rate. How do we arrive at that hourly cost?
So we first need to know what the hourly cost of an employee is. So in order to do that calculation, we're going to take their annual salary, fully burdened. So fully burdened includes their payroll taxes, benefits, all of their costs, right? So let's say a employee costs you $100,000 by the time you add salary and all the extra stuff. And then we divide that by 2080, and that gives you their hourly rate. So a $100,000 per year employee costs you $48 an hour.
Okay.
So if you have somebody for $100,000 a year, what do we need to then charge them hourly to your clients? If we mark that up by 4 times, that's $192 an hour that you need to bill that person out at. And a lot of times when people see that number, they're shocked because when they first start their business, they're like, oh, I'm going to mark it up 20% or 30% or 50%. But it's actually, you got to do 4 times the hourly rate. It's a lot more than you think because we need to cover our overhead costs.
And remember, when it was just one person, they didn't have that other overhead. So if they were charging $100 an hour, they looked at it like it was just profit. When it's just you servicing clients in the business, you don't have any of these things to consider. And so your prices may naturally be a lot lower when you're servicing the clients directly. So moving up to this, it is a bit of a shock, but prices do need to be corrected for you to be profitable, to make money.
Yeah. Okay. So once we've figured out what our target average billable rate is, and like I said, it's when I say average, I'm saying average because we're going to look at this across your entire employee base, right? Because we're trying to come up with sort of like a blended rate. If we're servicing clients on a fixed fee and you have employees, you may have multiple employees servicing one client on a project or on a monthly retainer. But there are other levers that we have, right? So if you do the math on that and you're like $192 an hour, my clients would never pay that for whatever you're delivering. There are other levers we have, right? So one of the levers is utilization rate. So we can ask our team to do more. In general, utilization rate for a service-based business, you want to be at least 80%. Now at Momentum, we actually work 36 hours a week, but our utilization target is 90%. So if you looked at it in 2080, it still ends up being around 80% total, but we don't screw around. Like we don't have an office. There's no water cooler talk. People get in, they do their work. A lot of our training is done on the job. We're not doing a lot of like long lunch and learns and stuff like that. It's just kind of like our culture, get in, do your work and work 36 hours, right?
Work hard, play hard.
Right. But I had to turn up that utilization notch in order for our business model to work and still be profitable. So you could lower your costs and increase your utilization. You could lower the amount of hours that your team works and increase your utilization or increase your costs. And then the other lever we have is lowering our cost per hour for our labor. So that could be going and offshoring. It could be finding labor in a different market. You know, I'm in San Francisco. Do I hire people in San Francisco? No, not unless they can, I need them to physically go to clients because for the most part, we're delivering services online. So I'm going to take the opportunity to find cheaper labor, right?
So lower costs just so you can reduce that amount because your customers won't pay it. Is that the logic here? If you don't think you can charge 192 to your current client base, could you do these things and then charge less?
Yeah. So then that's when we need to either lower our cost or increase our utilization target. So one thing that we have in the accounting space, right, or actually a lot of times I see in all sorts of professional services, is employees working a lot of overtime, getting burnt out, working overtime. And that's probably because whoever's doing sales is pricing too low to try to get the client in the door. And then on the back end, your team has to work overtime. And this creates issues. Pricing low creates all sorts of issues. It means that you can't attract top talent. It means that you can't pay your team good benefits. It means you're going to have a lot of turnover because people are going to be working more. You have to consider that when you're selling something of like, is it worth it to take on this extra piece of work at a low cost or low price rather? Because what you're going to end up doing is you're going to be on this hamster wheel of clients, team members, working a lot. So it might be better just to hold out for the client that's willing to pay the price that's high enough so that you can go hire good people.
So this goes back to what we were saying with Walmart versus Porsche, right? Like lower volume means that you're going to grow slower, and you're going to have to be patient to find those clients that would be willing to pay those higher prices because they are out there. And then you end up growing a business that's built on high margins too. So I would think that the better strategy is to say, okay, 192, if most of my clients won't pay that, where are the clients that will pay that? And find those clients that will and be patient for that. Because, if you're going to the cost-cutting route, then you're going to have the cheaper employees and the lower cost option, and you're going to be more like Walmart. So you have to consciously decide which direction you want to go.
Yeah. And we talked about that last episode of finding clients that if there's a certain size of client, right? If the smaller businesses can't afford your price, those probably aren't a good fit for you. You need to go up market and figure out how you attract those clients or how you get in those water coolers, or you choose a specific industry niche so that you have higher perceived value for your services.
Mm-hmm. So we're still at this 192 as our rough target price, right?
So that's for one employee. So let's say we do that for all of our employees, and then we come up with an average number. So let's say the average is 192 as well. Okay, so we have
we're
5
paying an
employees
average of 100,000. All of our employees are making average of $100,000, right?
Yeah. So then that becomes our target average billable rate that we want across our portfolio of clients. Then we can do a quick calculation to see how much each of our employees on average should be generating in revenue. And then from there, we can figure out with our current existing team, how much revenue we should be generating as a company, and then compare that to what we're actually generating. So in that example, if we take the 192 per hour, and then let's say target utilization is 80%, and then we multiply that by 2080, then our $100,000 per year person should be generating $319,000 on their portfolio. So a good target would be, okay, maybe we're going to, and we chose 4 times, right? So maybe we're aiming between 3 and 4. So maybe we say, at a minimum, I want everyone to be generating $300,000 in revenue. And then we break that down by month. That means that each employee every month should be generating $25,000 in revenue. So one KPI I like to look at is what is my revenue for the month divided by my full-time equivalent. So if you have part-time people, let's say you have 5 full-time people and 1 part-time, half-time, you divide total monthly revenue divided by 5.5. And then you have that $25,000 a month KPI target. And then that's actually how I figure out when I'm going to need to hire somebody. I use that as my kind of capacity planner. So when I forecast out the year, I know when my revenue per FTE starts to get above 25,000 in a month, then that's the month I'm probably going to need to bring somebody on. So then the month before, 2 months before, I need to start putting up a job description, start interviewing.
So you've sliced it a few different ways here. You've sliced it on an annual amount, on a monthly, and even down to the hourly. So you know roughly what your people should be handling and what you should be charging to ensure a high profit margin.
Yeah. And then the other thing we do each month is we look at by client our average billable. So we talked about our average billable rate target, and then we look at what actually happened. So, and then we rank our clients in order from best to worst. And then we look at the trailing 3 months and the trailing 6 months. Sometimes the clients in onboarding, so those ones are kind of ignore. Those during onboarding, we don't really care. Just get them on Sometimes we win, sometimes we lose. And then we've noticed that sometimes it takes like 6 to 9 months before a client will normalize.
Wow.
It takes there's onboarding obviously, but there's still just like tweaks and stuff that we're doing and getting used to them and them getting used to us.
We also have other seasonality items that could come up. If it's different seasonalities within the year, you're not going to see that until it happens.
Like January is always like a big spike in work because we're doing extra work to get all the books closed for the year. So we have to look at it a little more subjectively, I guess, because knowing that there are certain times of the year, or like we also had a new employee come on. And so there was like a huge spike in work on certain clients that she was working on. Well, that's training time basically, right? So we have to be careful about not making decisions solely off of time. So it's more of like a leading indicator so you can figure out what's happening. Then you can go talk to the team and then it's like, okay, somebody's training. We're not going to go reprice that one. But if a client's onboarded, stable, people working on the job, and then you see the hours going up, then we might investigate what's happening. Is the business growing? Is there more going? Are they asking for more? What's creating that decline in the ABR?
Again, we still have this target, right? Like 320,000 or 25,000 per month or 192 per hour. What's our walkaway price here?
Yes, that's a good question. So when I was talking about wanting to charge 4 times whatever the hourly cost is of an employee, maybe we go as low as 3 times, right? So in our example, 48 times 3 would be $144 an hour. So when we're scoping a client and we're trying to figure out how many hours we think it might take us, so let's say we think the client's going to take 10 hours of our time per month. We multiply that by $144, our lowest price that we'll do it for. And so that means our walkaway price for that client would be $1,440.
You want to target somewhere closer to 2,000, but you can walk away, or 1,920, right? You want to target that higher price, but knowing your walkaway is very important before going into pricing any of these. The walkaway is your standard 3 times cost. And that's typically our like rule of thumb on the back of the napkin, where we're trying to figure out roughly what we can make. And you're saying a certain allocation of that is to overhead and a certain allocation of that is your cost of goods. And that's what's going to get us still profitable. That price is still profitable for us, but anything below that, you're not going to make any money. You're going to be losing money.
Right. That's going to give you enough margin for that waste that we talked about. And then that should keep you always, or that should keep your direct costs always below 50% of your revenue, which means you'll always have enough to cover overhead, which means you'll always make that at least 20% net profit that we talked about. Simple math, right?
Awesome. Simple math, simple solutions to complex cash flow problems. Usually the problems are always so complex for the owner, but it goes back to some of these simple foundational fundamentals.
You got it.
All right. Well, thanks for tuning in with us today. Please leave us a review. We've got a new review on Apple Podcasts. So if you're listening to us on Apple, please hop in there and leave a review. We got a review from Wise and Smart. As a small business owner that has constant cash flow concerns, the information they provide in this podcast is beyond helpful. Love this show. Thank you, Wise and Smart. That she does sound very wise and smart. She or
Why
he.
do you think it's a
Not
she?
sure.
Yeah. I thought it was a he.
Yeah, maybe it is a he. I said she because last time I said he, you got mad at me. So I'm trying to balance this out. All right. That was intentional.
Well, it's funny how we all make assumptions in our mind. But thank you, Wise and Smart. We appreciate you.
I think most people that are wise and smart are female. That's my baseline here. Males are typically not wise or smart in a lot of scenarios. I'm kidding. Kidding all the guys listening. Leave us a review, subscribe, tune in again next week on the Cashflow Show. We got another very special episode for you. If you're not drowning in cash flow issues and you have an overabundance of cash flow, this is the episode for you. Tune in to episode 20 where we talk about having too much cash.
See you, Scotty.
Peace out, homies.
Yeah. you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cashflow Show. This is the Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Our advice will take you far. With Nikole and OKR.